Namaskar, welcome to my YouTube channel where I have started my series on the fraud under the Companies Act. This is my fourth video, so I would like to introduce myself first because there might be some viewers who are viewing this video the first time. I am Dr. Sanjeev Gupta. I am a member of Institute of Company Secretaries of India. Since 1994, I am a law graduate from Delhi University. I did my Ph.D on the topic corporate frauds in India, nature, consequences and regulation. Friends, first of all, I convey my thanks to all of you for motivating me to prepare these videos, educational videos for the benefit of general public as well as for the benefit of the professionals and the management. In this video, I will cover the types of fraud, the manipulation of financial statements, which is the topmost and most common practices adopted by the management for manipulating the financial statements for committing a fraud. So, through this video, we will discuss or we will try to share our knowledge. What are the financial statements? What's the purpose for making these financial statements? What are the types of the financial statements? Who are the users of these financial statements? How the financial statements are manipulated, as well as how to analyze the balance sheet of a company. As you know, there are the three types of entities which can run the businesses either as a sole proprietorship or partnership or a company. Since our series covered the fraud under the Companies Act, so we will talk only about the companies which are registered under the Companies Act 1956 or the Companies Act 2013. Friends, what are the financial statements? The financial statements have been defined in Section 2, Subsection 40 of the Companies Act 2013. The financial statements includes the balance sheet of the company, the profit and loss account in case of commercial companies, and income and expenditure account in case of companies which are incorporated for non-profitable companies, and the cash flow statement wherever it is applicable, and a statement on the equity, as well as the last one is any information annexed or annexures forming the part of the balance sheet, profit and loss account, or cash flow statement, or the statement of equity. Please note that the cash flow statements is not applicable. It is not mandatorily to be prepared in case of one-person company, in case of small companies, and in case of government companies as defined under the Companies Act 2013. So the financial statements, the legislature, while using the definition, defining the financial statements, it uses as the financial statement includes as distinguished the word financial statement means. Now the question is whether there are other documents or other informations which forms part of the financial statements. Yes, there are other informations or other documents. What are these? Number one, the board of directors report. There are number of contents or number of you can say information that is contained in the board of directors report, like financial positions, like directors responsibility statement, like cases of the sexual harassment in the company, foreign transactions, like that. Number of other informations are required to be given under the Companies Act. And the major one is also the auditor's remarks, auditor's report, and the director's qualification on the auditor's remarks, if there are any qualifying remarks. So besides director's report, another document that include in the financial statement is the auditor's report. Each and every company is required to appoint an statutory auditor, and it is the duty of the auditor to give the reports on the financial statements of the company that is included in the financial statements. Besides this, the directors' discussions and analysis and segment-wise reporting of the activities of the company as per the accounting standards. So these are the other documents which may be part of the financial statements. Now broadly, we can discuss about the balance sheet, profit and loss account, income and expenditure account in case of Section 8 companies which are NGOs, and the cash flow statement. What is balance sheet? Balance sheet shows all the assets owned by the company and all the obligations or liabilities payable to the creditors, the outsiders of the company. The profit and loss account shows the working operating results of a company. How much revenue have been earned and how much expenses have been incurred to earn these revenues. This is the profit and loss account. And the cash flow statement, from where the cash comes and where the cash goes. So cash flow statement, as I told you, is not applicable in case of small company, one person company and the dormant companies. These three documents mainly consists of the financial statements besides the director's report and auditor's report. The success of any business requires a focus on all these three statements. And the basic objectives of these statements is to provide information required for decision making by the management as well as the outsiders who are interested in the affairs of the company. So, the balance sheet, profit and loss account, and cash flow statement should be prepared in such a manner that shall reflect true and fair view of the financials of the company. So these financial statements, as per section 129, subsection 1 of the Companies Act 2013, shall reflect or give a true and fair view of the affairs of the company. Next, it should comply with the accounting standards as well as it should be in a form as described under Schedule 3 of the Companies Act. Friends, it shall give true and fair view. True and fair view is not defined under the Act. It is the professional judgments, management judgments, what is required and what is not to be required, what is true and fair. So it depends on the professional judgment. Although it is a matter of the court to decide whether the financial statements are given on a true and fair basis or not true and fair basis. Yet these financial statements may be of two types: the annual financial statements or the quarterly financial statements. The annual financial statements, which are prepared annually, and the quarterly financial statements, which are prepared quarterly as per the requirement of the SEBI. Each and every company is not required to prepare the quarterly statements. Only the SEBI, the listed companies, or where the SEBI Act and rules are applicable, they are required to prepare and submit the quarterly financial statements. So friends, the balance sheet. Balance sheet shows the assets and liabilities of an organization as at the end of the year. The profit and loss account for the financial year. Cash and flow statement for the financial year. So please note that balance sheet is prepared on a particular date and the figures reflected in it since the incorporation of the company till the year the financial year closes. The profit and loss account talks about only about the financial position of the company related to a particular financial year. Similar, the cash flow statement is also reflects the figure for the financial year, means for a particular financial year. Who are the users of these financial statements? The financial statements are used by different persons. One, investors who have invested their money. The investors are concerned about the risk and return on their investments. They assess through these financial statements the ability of the company to pay dividends as well as to grow in future. And they can decide on the basis of the financial statements whether to buy or to sell or to retain their investments. So these informations are useful uh, for the investors to take such decisions. Then the employees. The employees are concerned or interested in the information of the stability and profitability of their employers and the ability of the employers to pay the salary and remuneration in time. Next is the lenders. Lenders means who has given the money to the company. The lenders are interested in the financials because only the financial statements enable them to determine whether the borrower are in a position to return my money whenever it is due or not due. The next, who is interested in the financial statements of a company are the suppliers who are supplying the goods or services to the company. They are interested in knowing whether their dues will be paid in time. The next one is the customers. Customers who have a long relationship with the company. So they are interested in the financial statements of the company. The government and the other authorities. Why the financial statements are used by the government authorities? Because the government is interested in the activities of the company so that they can regulate or they can make regulations or amend the acts in order to regulate the activities of the company. So these persons are the general users of the financial statements. So friends, the financial statements are the balance sheet, income and expenditure account of the profit and loss account and the cash flow statement. These are very useful for the lenders, for the investors, for the bankers, for financial institutions, or for the government. Now, these financial statements are manipulated by the owners or the employers. Why these financial statements are manipulated? The manipulation of financial statements is one of the types of corporate frauds that is prevalent in the economy. The financial statements are manipulated by inflated sales or by increasing the profits of the company in order to show the good working results of an organization, so that through these financial statements, which are the manipulated financial statements, the owners or the employees or the company can mislead the banks or the financial institutions in order to get the more and more working facilities, as well as it can show a rosy pictures to the investors to lure the investment by the public at large or by the debenture holders or by the foreign investors. So these financial statements are manipulated by the organizations or by the companies in order to lure the investors or to cheat the banks or the financial institutions in order to get more and more funds in the company. What are the modus operandi of manipulation of financial statements? How the financial statements are manipulated? What are the types? How the management can manipulate these financial statements? Number one is overstating revenues or fabricated revenues. Now you see that the balance sheet is prepared on a particular date, and that date is 31st March. As per Income Tax Act, the financial year means 1st April and the 31st March of the following year. Now the balance sheet figures are prepared on a particular date, that is 1st April to 31st March. Okay. So if you see the balance sheets, it reflects as balance sheet of such and such company as on or as at 31st March so and so year. Now how the management fabricate revenue under these balance sheets? Bogus or fake bills, fake invoices are raised to increase the turnover of the company. How? The fictitious revenue is generated through the sale of these fake bills. There is no movement of goods from factory or from the seller to the buyer, but there is a sales recorded in the books of the company. The goods are sold on 28th March of a particular year, and these goods are never moved from the seller's godown or the seller's warehouse to the buyer's warehouse. It is merely an entry. And in the next month, either on 2nd April or 3rd April, these goods are returned back and the entry is made in the balance sheet that the sales return. So, what happened? The sales has been increased on 31st March because the goods were supplied, invoices were raised on 28th March. Two parties are manipulating the stock as well as the sales. The party who is selling, it is increasing its sales by these fake invoices as well as increasing the revenue through these fake invoices and getting more and more working capitals from the banks. Similarly, the buyer party, who may be also a company, it is increasing its stock because goods are purchased by this company. Now, on 31st March, since the invoice is raised on 28th March, these second company, the buyer company, is showing stock, closing stock in the books of the company. And on the 2nd April, it's also showing the purchases return. So this company is also getting the money from the banks on hypothecation of stocks. Another example of overstating revenue is the next year sales is taken into record in this current financial year sales so as to increase the sales of the company as well as to increase the revenue of the company. Next one, the sales return is not shown in the books of the company. For example, if there is a sales return on the 30th March, the company did not make entries on 29th March or the 30th March. Rather, it entered the entry in the books of the company as sales return on 1st April, on the 2nd April, so that its sales will not be decreased. So, this is the overstating revenue or the fabricated revenue. Next one is the understating expenses. Friends, there are certain expenses which can be spread over a year. For example, if an organization is purchasing an assets, so that assets has a useful life, say for 10 years, 15 years, or 20 years. So expenses incurred on these assets are the capital nature expenses. They are not shown in the profit and loss. Rather, it is shown as an asset and the expenses are shown in a spread of years by through depreciation process. How the companies manipulate these expenses. Suppose in a depressed sales market, the company incurred a huge amount on the advertisements on the products of the company, either through media, either through newspapers, or any other. Since these expenses are the revenue nature expenses, but the company is not showing these expenses in the books of the company in a particular year. It is showing these expenses in 3, 4, or 5 years. So this is understating expenses. Why the company adopt this type of practice? So as to increase the sales, increase the revenue of the company. Since all the expenses are shown in a particular year, then the expenses will be on the higher terms and the sales as compared to the expenses, the revenue will be decreased. Now, next one is the inadequate disclosures. Inadequate disclosures means certain requirements are there. A company is required to prepare its financial statements on the basis of accounting standards, on the basis of the format given under Schedule 3, and it shall also reflect the true and fair view. So proper disclosures must be there. Now, what is the are the examples of the inadequate disclosures. Not disclosing the qualitative aspects of the statements. Like, suppose there are certain pending litigations in the company, and if the company loses these cases, an huge amount can be paid by the company. So this is the contingent liabilities. But the companies never discloses the contingent liabilities in the balance sheets of another example is the fudging of accounts, misclassification of heads of accounts. For example, two items are there, loans and advances. The company has given certain loans and advances to certain parties, and the company has certain parties from whom it has to receive money against the goods or services supplied by the company. These parties are called the debtors. So, to whom I have given loan or advances, that is should be shown under the heading loan and advances, and to whom I have supplied the goods and they are my debtors, that parties shall come under the head debtors. But the companies generally merge these two things. Loan and advances are shown under the head debtors. Why? Because bill discountings are there. The bank or financial institution grants the working capital facilities on the basis of the debtors of the company. So, in order to increase the debtors of the company, the financial statements are prepared in such a manner that the loans and advances are merged into debtors of the company. The next modus operandi of manipulating the financial statements is the overstating assets. In this method, the financial statements are prepared in such a manner that the assets are overstated to the prices of these assets. There is a general principle that the asset should be shown on a cost or market price, whichever is low. But certain times, the company shows the goods or assets of the company on the market price instead of the cost price. When the market price is more and the cost price is less. The understating assets. Understating assets means the depreciation is charged in such a manner to decrease the value of the assets, either straight line method or diminishing return method. Once a company is adopting a particular depreciation method in a year, it is supposed to be followed in the subsequent years. But certain times the company changes the methods of depreciation. Why? To procure more and more assets. Why the assets are overstated? In order to lure the investors. Why the state assets are understated? In order to get more and more funds from the banks for procurement of these assets. In Satyam case, what happened? In Satyam case, the company increased or inflated the cash at bank balance in its financial statements. That is overstatement of overstating assets. Two types of assets, fixed assets or the current assets. The current assets are the cash in hand, cash at bank, debtors. So, by making fictitious sales, we are increasing the amount of debtors. By showing the value of the assets not on the basis of the cost price or the market price, whichever is lower, but on the market price, wherever the cost price is less, in order to inflate the financial assets of the company and to get more and more investors from the market. Similarly, understating assets, the depreciation is charged in such a manner so that an proposal may be given to the banks for procurement of assets. We need the funds. So, this is another type of modus operandi which is adopted by the management to manipulate the financial statements of the company. The another modus operandi to manipulate the financial statements is the transactions with the related parties. Related party means in which the directors or the officers or the KMPs are interested if a particular transaction is done with this type of companies. For example, there is a company, it has another company B, or a proprietorship firm or a partnership firm in which the A and B, the directors of the company, are the proprietor or the partners of that particular company. They are getting the services from that proprietorship or partnership firm as the job work is done by these firms for the company. Now, how the related party transactions are a source to manipulate the financial statements. If I am giving certain items or I am getting the job work from a party in which I am interested, what happens when the finished goods comes into my company? I will never calculate or never show the scrap value, whichever is an huge amount. The scrap value, it is also uh, related to the party who is giving the job work to you. If I am interested or I am director of a company and I am proprietor of the B firm and the A is getting job work done from B, so B is selling the scrap which does not relate to it. So under section 447, if you remember, the Companies Act explained that fraud, it is an act, it is an omission, or it is concealment of information, or abuse of position by any person with an intent to deceive, to injure the stakeholders of the company for any wrongful gain or wrongful loss. So, in such circumstances, the A is incurring loss and B is getting wrongful gain. First. Second, another example of the related party transactions. How the funds are siphoned from one company to another. Suppose a company A is there and a B company is there in which both the directors are the interested or the directors or one of the directors is interested. What happens? A want to purchase some items and instead of buying these items from the open market, he is purchasing the items from B. Why B? Because the directors are interested in the B. The prices in the open market are not compared with the prices as prices quoted by B. This is called the siphoning of funds from one person to another person. Next, the modus operandi. The investments of the company, the surplus investments of the company are invested in such companies or in such entities which which entities has no listing status or whose shares are not listed or whose shares are not traded in the stock exchange. So the funds of the company are diverted from one company to another company by making investments in those companies. So these are some examples of the manipulation of financial statements, or we can say these type of practices are adopted by the management to manipulate the financial statements. Now next, how if I am a layman or I want to invest the money into a company on the basis of these financial statements, how can analyze the balance sheets of the company. One example I will give here. You will see that there is a provision that if the company has some doubts on the recovery of any debts, it has to create a provision for bad and doubtful debts on the company. Okay. And as per Limitation Act, the Limitation Act says that if there is any financial transaction, you can take the recovery suits within a period of 3 years from the date of the last transactions. What the companies do, they are not making any provision for bad and doubtful debts. And suddenly, in the next financial year, you will see that a huge amount has been write off as bad and doubtful debts. So we have to see what recovery procedures have been adopted by the company to recover these debts. If there is no recovery, or if there is no show cause notices, there is no litigation, etc., it means that it is siphoning of funds and the balance sheets are manipulated. So, friends, in this video, I tried my best to deal or to discuss some examples how the financial statements are manipulated. In my next video, I will try to explain another type of corporate fraud, that is misappropriation of assets. Thank you. You can reach me at 9810079135, or in the last of the video you can get my other particulars like my mail ID, my blog address, my office address, etc. Thank you. Namaskar.